I am joined by Joe Castiglie, COO and CIO of Sykon Asset Management. Joe, great to have you here.
Thank you for having me. I'm excited to be here today with you to talk about ETF products, specifically FMKT, which my team recently brought to market.
Yes, and I know that you're really looking to capitalize on shifts in the regulatory environment, but let's take a step back and talk about progress, because there was, of course, a lot of optimism in terms of the new Trump administration about what it could mean for growth in the overall regulatory landscape. Where do we stand in terms of progress made?
So I think there's been, the pace of executive orders that have come out recently has been tremendous, and it's touching on a number of different sectors throughout the economy, energy, with focus on nuclear energy, vertical takeoff and landing vehicles. We've seen some executive orders around that. There's been cryptocurrency and digital asset legislation that's come out. So I think the pace has been okay to this point. I think our personal feeling is that that's going to pick up. I think when you look at the Trump administration's policies, they've been looking at tariffs, they've been looking at the tax reform bill, and obviously we're still negotiating some of those tariffs at this point. That deadline seems to shift almost hourly, but the tax reform bill is now done, and so it's our belief that the next focus, the next pillar is going to be how do we deregulate and lower the burden for American corporations.
And what industries stand to benefit most from that potential deregulation?
Yeah, so we believe energy is definitely one that can benefit. As you look at the growth of AI and data centers, the demand for energy use that's cheap and stable is only going to continue to grow, and so we believe there's going to be some effort there to, cut regulation and allow for things such as small modular reactors and more nuclear plays that provide that stable energy. I would also say financials. There's been a lot of talk recently about scaling back the capital requirements for banks. That has a knock-on effect throughout the economy as it lowers capital costs and it injects liquidity into the system. Specifically, I think regional banks can benefit there.
What about tech?
I think there can be some benefits for technology for sure. AI, a more friendly AI regime can definitely help technology, as that's really the focus for the mega cap tech names. They're all spending like crazy to hire talent. It seems like almost every day there's somebody leaving a company to go to Meta right now. So I think AI is an area where they could benefit, and they too would stand to benefit from energy costs coming down or capital requirements being lowered that injects capital into the system, because it lowers their cost of capital and lowers their input costs for their overall business, which boosts their operating margin.
What are your expectations in terms of potential M&A? Because there was also a lot of optimism about a pickup in deals, and we haven't necessarily seen that. Do you think that's a result of all of the economic uncertainty, the tariffs, as you mentioned, or do you think that's actually a result of a tighter regulatory regime than maybe expected?
I think the uncertainty is the big thing there. I think a lot of companies like certainty in their cash flows and how they're modeling things out, and the market itself is a mechanism that prefers that certainty, right? When you have uncertainty being introduced to companies' earnings, it creates uncertainty and volatility in the market. I think if I had to look at one space in particular where there could be some activity, I would look at regional banks. They've underperformed versus the broader financial sector. They've underperformed versus the market. And I think if you lower those capital costs for larger banks, there could be some M&A potential there. And there could be some consolidation just within the regionals themselves.
So I mentioned you're looking to capitalize on some of these shifts in the regulatory environment with your free market ETF. Tell me about the biggest holdings there and how you're looking to do that. Something tells me there's some regional banks in there.
So yes, we recently added some regional banks. We added a few different names, not among our largest positions. We chose to broaden it out among a few different names: Citizens Financial, Huntington Bankshares, Key Corp. Those are a few of the ones that we've recently added. I think we've decided to take a play on the sector more broadly rather than picking individual names directly.
But what are some of the biggest holdings then?
So some of our biggest holdings are in some of the sectors that we've already discussed. Energy, so we have Uranium Energy Corp, UEC. We expect uranium and nuclear is going to continue to play a role in bringing those energy costs down. I think there's been a push towards small modular reactors. I think we're going to see that, and just enhanced approvals, it's expedited approvals for nuclear reactors. Another area is financials. One of our biggest is Robinhood. We believe they'll see some benefits from some of the recent executive orders around digital assets and cryptocurrencies. There's also been the stablecoin legislation. And lastly, there's potential benefits from more relaxed AI standards for financial companies. And then the last area is McKesson in healthcare. We think there's potential for some FDA approvals that get expedited. We also have heard some inklings of domestic reshoring and some incentives to move production domestically. And as a benefits distributor, that would help them.
I was taking a look. I also see names like Uber and DoorDash on there. Why do those names have upside potential as it relates to deregulation?
So when you think about the gig economy, there's a lot of regulation around the categorization of employees, and that is their biggest cost, right? The delivery drivers that are making the deliveries for Uber or that are picking you up to take you to the airport or wherever it may be, the categorization of those people as either employees or contractors is a really big sort of battle that those gig economy companies are facing. And the reason for that is because there's a big classification difference within the tax code and what you have to do in terms of paying someone benefits and things of that nature. So if they're not categorized as employees, theoretically, you're lowering the operating expense of hiring those employees or contractors, and thus boosting operating margin.
As you think about it as a broader market catalyst, how much is already priced into the market in terms of expectations of this deregulation and an easier regulatory environment?
I actually think it's fairly underappreciated. I think the uncertainty around the tariff environment, there's been a lot of uncertainty geopolitically. There has been a big battle over the tax bill that was signed into law last week. A lot of skepticism around the debt levels that that bill may or may not cause. And as we were saying just a minute ago, right, uncertainty is something that the market does not like, and it's something that companies don't like. And I think there's a lot of people who are undervaluing the potential for deregulation and what that could do to the American economy and American companies.
Yeah, the S&P 500 is very close to all-time highs, despite all of this uncertainty, and despite the fact that we haven't seen necessarily the deals that we thought initially we might see. It sounds like you think that those are coming. So all of that being said, where do you think the market goes from here?
Well, just today there were a number of analysts that raised their price targets for the S&P. I think we're about to enter earnings season. I think it's going to be very interesting. The market itself has been very resilient. I think the operating efficiency of American companies has been very, very strong. And I also think we've had a resilient consumer. So I think we're going to see, as we go through the earnings season, what exactly we may have in store for the back half of the year. I would venture to say it will likely be higher. Because I'm thinking that there's going to be some movement on deregulation. We're going to get some certainty around some of these tariff agreements. You have the potential for rate cuts out there. And generally speaking, the positive momentum begets more positive momentum.
All right, we'll leave it there on that positive note. Joe, really appreciate your insights. Thanks so much.
Absolutely. Thank you for having me.